Hello, welcome back. We are taking a look at Spotify. The company is actually losing 10% today after reporting earnings. It looks like they missed on guidance for the most part, and this can really affect the performance of the stock in the day. And let's take a look at what's going on right now because this could be a prime opportunity to actually buy a little bit of Spotify. But in order to do so, we need to see what kind of financials the company has. And it has been down 67% from its 1 year high. I'm pretty sure it was overvalued back then, but is it overvalued right now? This is what we need to examine. And if you take a look at the month chart over here, which is the default, you will see that the company has been in a downtrend. And take a look at the 6 month, again a downtrend here. The 1 year again kind of points to a downtrend. And if you take a look at the max chart, you will see that the company is actually less than its IPO days. So it could be an interesting opportunity here, and we're going to examine that. So, first things first, take a look at the stock news module here, just to tell us what is going on. You can kind of see all these articles here about the company. The one that I'm using, this one, I'm going to open up. Why Spotify stock was sinking today? Disappointing guidance pushed the stock lower this morning. It looks like they had the solid growth here, good numbers and stuff. Revenue was up 24%. That's pretty good. So revenue growth looks fairly good over here. Gross margin fell a little bit. That's not a big deal. It's a very small loss over here. It can happen. And the thing is, it's what they projected for the next quarter really that potentially could cause a problem to the stock, and it looks like it's down for this reason for the most part. Now, an interesting thing that you definitely don't like to see is that the free cash flow in the quarter declined from 41 million euros to 22 million euros. This is something that I never like to see, although there could be legitimate reasons, like, for example, an increase in capital expenditures. So this is something to note, of course. And it looks like a big thing is the outlook, as I mentioned earlier, for the second quarter. As the subscriber forecast misses estimates here, so they see premium subscribers increasing to 187 million, that's Spotify, compared to the estimates of about 189.4 here. So less subscribers here, and it assumes it will lose another 600 subscribers. That's the forecast actually. So it looks like it's gonna be doing a little bit worse than that even, and that is a little bit of a problem. Now, is that an overreaction? I think it is. But as investors here, we want to make sure on whether it's actually a potentially good idea to maybe again add it to our portfolio, because news come and go, sentiment comes and goes. The thing that really matters is how well the company is doing and whether it's investable or not. Now let's take a look at the financials. Let's take at what they are doing financially here. So first, red alert here, negative PE ratio. That's something that I never like to see because it's pointing to a company that is losing money. And if we take a look at the net income growth, you can kind of see that although there has been positive growth, we are still in negative values, and this is why the PE is negative. A bad thing to see, I don't like that. The price to free cash flow is positive, and you may be wondering how this is happening. I will explain later when we take a look at the financials in detail, because this is something that you can see with a lot of companies that are not really profitable. Negative net income, positive free cash flow. It's a very normal thing in many unprofitable companies. Outstanding shares, which have increased a little bit, 8.8% it looks like, another X because we're getting diluted. Not massively, but still, it's a pretty interesting dilution number here, 8.8, almost 10%. Now look at this one, free cash flow to total liabilities. If we take last year's free cash flow, it would take us 18 years to pay all the total liabilities that the company has. That's a significant amount of liabilities for the company. That includes debt and other liabilities. Could be money that is owed to suppliers and things of that sort. In terms of the equity growth here, the total equity growth, it has been increasing, although lately it's going down a little bit. The free cash flow, again, we will discover why this is happening, why it is very positive when the net income is actually very negative here. And the revenue growth, at least, has been increasing, and that's a good thing. We have more sales. Now, the price to sales ratio is kind of low here. That's nice to see, because this means that we're having good revenue for the price that we pay for the stock. And that's generally speaking a good value for non-profitable companies. If you're looking to buy one, 1.69 would be a good value. Now, I don't like these negative margins. It's something that I seriously hate, and I also hate the negative return on equity. These values alone would probably prompt me not to invest in the company just by looking at this. But let's take a closer look, of course. Debt to equity ratio here, 0.484. It's fine. This is a number that is fine. Generally speaking, when it's more than one, I like to take a little bit of a closer look at what is happening. It could be lower, but I think it's fine for now, especially when we know that the company has quite some liabilities here, which we will examine. Now let's take a look at what's going on in detail. Let's see what's happening here. So the income statement of the company, we are seeing a revenue that keeps increasing from 5 billion to 11 billion here. And if we go down, we will see that the net income has been very negative and pretty much negative every year. So the company is losing money, it's not making profit here. Now we will see how this becomes free cash flow a little bit later. But for now, let's take a look at the total equity of the company, which keeps increasing here. Although it was actually better in the previous year, 2020 that is, fiscal year. And now we're looking at 2.4, so it's actually going down a little bit. Okay, so now the elephant in the room. How do you get from negative income to positive free cash flow? And the way to do that is stock-based compensation and depreciation amortization for the most part. I have talked about it in multiple videos in the past. What this happens here is that these companies are paying their employees with stock. And when you're paying your employees with stock, you are not paying cash. You are paying with a non-cash item. And since this is not a cash item, it needs to be excluded from the cash flow statement. And so this is why it's added back to the cash from operating activities, because it is not a cash expense and it was deducted from the net income. This is why the net income is negative, while this becomes a positive number and gets added to the overall figure. And the same thing happens with depreciation and amortization. It gets added back to the net cash provided by operating activities, which is why my DCF module actually has a reliance of free cash flow to net income. This is why I'm using free cash flow to net income margin, because I want my free cash flow to be derived from positive net income. Otherwise, it doesn't make sense. It's not very sustainable. We're looking at, practically speaking, non-profitable companies, even though you are seeing positive cash flow here. So again, the free cash flow is positive, but we kind of established why. And look at this. This is also positive numbers here. It means that the company is getting extra debt in the last couple of years. So figures are not looking great over here. Now, if we go back to our stock evaluation tool, you will see why it is important to correlate the free cash flow to the net income. Now, we will see that the revenue growth here has been pretty much 22 to 26. So let's just say that I'm using high values for the sake of the exercise. I'm going 18, 20, and 22, which is very, very high. Net income margins, look at these margins, they're all negative. This is why it's important to have a net margins here on this module. Net income margins, what are you going to use here? Now, you can use a DCF model to actually predict that the company is going to be profitable, but it has to happen soon. And the problem is, if you're buying a company that is not making money, what are you buying? Like, why are you buying a company that is not making money is the question. Now, you could say that the company could make money, but anything could make money. And anything may lose money also. So most companies tend to become unprofitable if they are unprofitable to begin with. So you are taking extra risk, significant extra risk, because it's easy to see at a company like Amazon and see them being negative for many, many years, and then all of a sudden they boom. But you are forgetting the survivorship bias. You are looking at one company while 1,000 other companies have actually failed at what Amazon has achieved. And so when you're looking at Spotify being unprofitable, the only thing that you have to show for is the brand name. And so the brand name is not really bringing bread on the table. What you need to be doing is making sure that you are using projections that make sense. So you can't really go something like 20% or 30% here. How are you going to derive that from what they are currently doing? Look at this, minus all over the place. You can potentially go maybe 2, 4, 6 here, and work your way up if you really want to. But I think I would stay here, and even these projections are aggressive because the company has been unprofitable, has been losing money. Now, the interesting thing and the nice thing is that this is going close to profitability. But look at what happened in the previous years. This was -1, -2, -7. And if I made this video in 2018, I would have said the same thing to you. You are buying a company that is unprofitable, yet it's close to profitability. But look at what happened in the next years. So this is why I urge caution here. You need to be very, very cautious and you need to be ready to take risks when you are willing to invest in these kinds of companies. So if you are ready to do that, let's examine how much you should be paying. That's the case. In order to do that, we need to be having positive cash flow. Otherwise, it makes zero sense to buy a company that is not producing income. You are not the owner of anything else, practically speaking. You only own the cash flow that the company will generate as a stockholder. So this is why, again, I urge caution here. The free cash flow, look at this one. This has been insanely negative. What are you going to do here? So this tells me how much of the net income becomes free cash flow. And it gives me a correlation between these two numbers, because I want my free cash flow to be derived from profitability again, and not from this sort of like accounting kind of tricks that make the cash flow look positive, yet it's just compensation added back to the free cash flow statement, the cash flow statement. So this is why I'm using these numbers, and I feel that this is a very, very good module, actually, very, very good way to do it personally. Now, again, I have to go positive here. I have to use something that makes sense and it's normal for companies, something like 70, 80, and 90%. We're very far from that, but I'm assuming that the company will become profitable, and the vast majority of this profitability will turn to free cash flow, which is what you want to be seeing. The annual return is 13%, is what I want to be getting in order to for it to make sense for me to buy. And typically I would probably add even 15 here, because I have a lot of risk with this company. But let's start with 13. And you look where we are today, it's only the high estimates here, with a revenue growth of 22% that are arriving at the current price. Basically, it's exactly the current price pretty much today. Now, frankly, I would use 15 to tell you the truth, and this will actually bring it probably to the red for the most part, I'm pretty sure. Yes, this takes it to 86 because we are discounting with a higher rate. We need a bigger return. Now, remember, we made some assumptions here that are very, very aggressive for the net income margin and the free cash flow margin. So even if you follow this, you are taking a lot of risk. For me, I'm not paying this current price. There's no way. I probably wouldn't even pay the medium price, to tell you the truth. If we were around here, I would probably think about it. This would be an interesting opportunity, but it's a very, very risky proposition to buy Spotify right now, based on what it's doing financially and what I'm seeing in the financials, because I'm taking a lottery ticket and I'm hoping it's gonna produce results in the future. And it hasn't showed so far that it can do that. Hasn't showed so far that it can do this. Thank you for watching. I hope you enjoyed the video. Please remember to leave a like and subscribe. Lots more coming out soon. And thanks for watching again. See you soon. Bye bye.